Canada has a tax-free savings tool that can quietly grow your money while you go about your day. If you're not using it well, you're leaving money on the table. In this video, we'll break down investing basics for Canadians with a clear, actionable plan centered on the TFSA. We'll keep it simple, practical, and easy to follow. First, what is the TFSA? In simple terms, a tax-free savings account is a place to hold investments where growth and withdrawals aren't taxed. You contribute with after-tax money, but when that money grows or earns returns, you don't pay tax on the gains. Your ability to contribute comes with a limit each year, and that limit can accumulate if you don't use it. The important bit is that you won't lose the room you didn't use. It carries forward to future years so you can catch up when you're ready. As of 2024, the annual TFSA limit is $7,000. The total amount you can contribute since the program started depends on past years you didn't use the room, so it's a rolling number rather than a single cap. Check the Canada Revenue Agency for your exact figure, or log into your My account to see your current room. What can you hold inside a TFSA? Almost anything that you could hold in a non-registered account, including cash, stocks, bonds, mutual funds, and most exchange-traded funds. You can also put guaranteed investment certificates or GICs in a TFSA if you want more predictability. Why would you choose a TFSA versus an RRSP? The big difference is how tax works. With an RRSP, you get a tax deduction now and pay tax when you withdraw in retirement. With a TFSA, there's no tax deduction up front, but withdrawals are tax-free, and you can recontribute later without losing room. A practical rule of thumb is to use a TFSA for money you expect to need before age 65, or for investments you expect to grow a lot. If you're sure you'll be in a higher tax bracket later, the TFSA's tax-free growth becomes especially valuable. If you're saving for the long term and want a tax break now, the RRSP may still fit in your plan. The two accounts can work together, not against each other. When should you start using your TFSA? As soon as you have some cash to invest and a plan. Think of the TFSA as a flexible growth engine for your money, not a place to stash every dollar forever. Now let's outline a simple, repeatable strategy you can follow. It has 4 steps: set goals, choose the right investments, automate contributions, and rebalance periodically. Each step is practical and designed to reduce decision fatigue. Step 1 is to set clear goals. Decide what you're saving for in the TFSA and pick a time horizon for each goal. A goal might be a house renovation in 2 years, an emergency fund you want to build, or retirement growth you want to start now. Step 2 is to choose investments that fit your goals and your comfort with risk. Low-cost index funds or broad ETFs are a solid starting point because they diversify across many companies and keep fees down. For most Canadians, a simple mix of Canadian, US, and global exposure works well, with a small portion in bonds or cash for stability. A concrete example: you could hold a broad Canadian equity ETF for growth, a US or global equity ETF for diversification, and a bond ETF to cushion volatility. You don't need to guess individual stock picks. You're aiming for steady, low-cost exposure to the market as a whole. Step 3 is to automate contributions. Put a fixed amount into your TFSA every month and set it to go to your chosen investments automatically. If you're closing in on the annual limit, you can adjust the monthly amount or pause temporarily, but automation reduces the chance you'll skip savings. Be mindful of the room you have. If you have a big year coming up, like a bonus or a windfall, you can contribute more, but don't overextend yourself. The goal is consistency over time, not trying to time the market. Step 4 is to rebalance once a year. Rebalancing means adjusting your holdings back toward your target mix after markets move. It helps you keep risk in line with your plan and prevents a single year's performance from steering your whole strategy. Here's a practical scenario to make this concrete. Suppose you're 30, you have a TFSA with a few $1,000s, and you decide to contribute $500 a month. You choose a simple 70-30 split, 70% in a broad stock ETF mix, and 30% in a bond ETF or cash for stability. Over time, you automatically add $500 each month, and at least once a year, you check your balance and rebalance if needed. If one part grows faster, you buy more of the lagging part to keep the mix aligned with your risk and goals. Withdrawals from a TFSA are tax-free, which is a big advantage. If you need money for an unexpected expense, you can take it out without taxes. The catch is, you can't recontribute that exact amount in the same year unless you have room, but you can recontribute in future years when you have room again. This makes the TFSA a flexible component of your cash flow and emergency planning. As you grow your TFSA, keep reasonable expectations about fees. Look for low-cost funds with management expense ratios under 0.25% if possible. High costs eat into returns over time, especially when you're compounding across many years. Another common trap is thinking a TFSA is only for big wins. The truth is, small, steady contributions compound significantly over time. You don't need a large starting sum to begin. You just need to start and stay consistent. A useful way to approach your TFSA at different life stages helps keep it practical. If you're a student, contribute what you can and learn the habit of saving. If you're early in your career, you can take a bit more risk with a larger equity tilt since you have time to recover from downturns. If you're nearing retirement, lean slightly more toward stability, but keep some growth to protect against inflation. Let's talk about a quick, realistic home for your TFSA investments. Think in terms of 3 buckets: a broad Canadian equity ETF for growth, a broad US or global equity ETF for diversification, and a bond ETF for balance. You can mix in a small amount of international bonds or cash for liquidity. The exact tickers aren't as important as the idea. Broad exposure with low costs, kept in a tax-free wrapper. If you're worried about making the wrong choice, break the fear with a plan you can repeat. Start with a low-cost, diversified mix, automate your contributions, and check your plan once a year. You don't need fancy strategies to build wealth. Consistency and low costs do a lot of heavy lifting. A note on record keeping. It helps to track your TFSA room and your contributions. Use your CRA My account to see your available room and to confirm how much you can contribute this year. Keeping accurate records avoids accidental overcontributions, which can cause penalties. What about combining TFSA with other accounts? It's common to use a TFSA for long-term growth and an RRSP for retirement savings, especially if you get a tax refund from RRSP contributions. You can switch between accounts as your tax situation changes, but plan so you aren't duplicating or conflicting with your overall tax strategy. Let's address a few myths. The TFSA is not only for rich people. Even small, regular contributions add up over time. You don't have to pick the perfect stock. Broad, low-cost funds give you reliable exposure to the market. And the TFSA won't magically grow wealth by itself. You still need a plan, discipline, and patience. If you want a simple starting point, here's a quick start checklist you can use this week. 1. Confirm your TFSA room and set a realistic monthly contribution. 2. Pick 2 or 3 low-cost funds that give broad exposure. 3. Set up automatic contributions into those funds. 4. Schedule a yearly rebalance to keep your plan aligned with your goals. 5. Track progress and adjust if your life changes. 6. Avoid high-fee products that eat into returns. 7. Share your plan with someone you trust for accountability. For practical tools, look for widely available ETF options with low fees offered in Canada. A common approach is to own a broad Canadian equity ETF for local exposure, complemented by a global equity ETF plus a bond ETF for stability. This mix gives you diversification without needing to pick individual winners, and it keeps costs reasonable. When you consider risk, remember that investing is a marathon, not a sprint. Market downturns happen, but a steady plan with a diversified, low-cost core tends to recover and grow over time. The TFSA is the vehicle, not the destination, and it works best when you ride it with consistency. As you absorb this, you may feel that you're starting late or you're not sure where to begin. The truth is that small daily actions compound into meaningful wealth. A steady contribution, a simple mix of funds, and a yearly check of your plan beat the latest hype and flashy but costly options. If you're curious about a specific combination of funds or want a rough starter portfolio tailored to your risk level, drop a comment below. I can share a few general frameworks that fit most backgrounds and goals, and I'll tailor them to your situation in future videos. Remember, this is general information to help you think clearly about the TFSA and investing basics for Canadians. Your personal situation can change what strategy fits best, and a quick chat with a qualified advisor can help fine-tune it. If you found this helpful, please like this video, subscribe to the channel, and leave a comment with your TFSA goals or the questions you want me to answer next. Your feedback helps me shape the next video and get you closer to your money goals.